The bond market plays an important role in our economy. It's actually bigger than the stock market. As of 2020, the U.S. bond market had some $50.1 trillion outstanding dollars invested, while the market cap for the entire U.S. stock market is just $40.7 trillion.
The moment you begin to understand money, you realize that the stock market is not its heart. The market is the spectacle, the daily drama of prices and personalities, the surface noise of capital. Beneath that noise lies a quieter, more fundamental, and far more powerful system. This is the world of bonds, and if you do not understand bonds, you do not understand money. You do not understand how governments fund their existence. You do not understand how corporations control their destiny. You do not understand how the wealthy protect and grow their fortunes, often while the world assumes they are simply buying stocks. To understand a bond is to understand a promise. It is a legal contract, a piece of paper or a string of code that states a borrower promises to pay a lender a fixed sum of interest over a set period and to return the principal at the end. But to see it merely as a loan is to miss the point entirely. In the real world, a bond is a claim on the future. It is a way to take cash today and transform it into a guaranteed stream of income tomorrow, assuming the borrower does not default. For the borrower, it is a tool to access cash without giving up control, unlike selling equity, which dilutes ownership. This single distinction creates a chasm in how the wealthy and the powerful think about money versus how the average person does. Most people, when they think of wealth, think of a salary. They think of a number on a paycheck or a balance in a checking account. They think of income. The wealthy, however, think in terms of cash flow, and the most reliable form of cash flow in the financial system is the bond coupon. Consider the difference in mindset. An employee trades their time for a wage. Their personal economy is driven by active income, which stops the moment they do. A bondholder does nothing. They have exchanged their labor-earned capital for a senior claim on the cash flows of an entity, whether that is a corporation, a municipality, or a sovereign nation. The interest payments arrive with the mechanical certainty of a clock, regardless of whether the bondholder works that day, sleeps, or travels the world. This is not a small difference. It is a fundamental shift in one's relationship to the economy. The bondholder is not participating in the company's growth in the same way a shareholder does. The bondholder is a creditor, sitting at the front of the line. In the event of a bankruptcy, bondholders are paid before shareholders, often receiving assets or cash while equity holders are wiped out. This seniority is the bedrock of the bond market. It is the reason why governments and institutions can raise trillions of dollars. It is also the reason why the bond market is the true barometer of financial risk, not the stock market. To understand why bonds are the foundation of money itself, you must look at the government bond. A United States Treasury bond is often described as the risk-free asset. It is a debt obligation of the federal government, backed by its full faith and credit and its power to tax and print money. This is the global benchmark. When investors around the world are fearful, they do not buy stocks. They buy U.S. Treasuries. They are not buying a piece of the American economy's future growth. They are buying a promise of stability and safety. They are buying a place to park vast sums of wealth with the expectation that the principal will be returned. This constant demand for government debt, often called the bid, is what allows the United States to run massive fiscal deficits. It is the mechanism that funds military budgets, social programs, and infrastructure. It is the engine of the state. When the U.S. Treasury auctions off hundreds of billions of dollars in debt every quarter, the entire global financial system pays attention. The interest rate on that debt, the yield, is known as the risk-free rate. This rate becomes the floor for all other asset prices. It is the cost of capital. It determines how expensive it is for you to borrow money for a mortgage. It determines how much a company must pay to issue its own corporate bonds. It determines the discounted cash flow models that equity analysts use to value stocks. The yield on the 10-year Treasury is the gravity of the financial universe. When yields go up, the price of everything that is priced relative to them goes down. This is not a secret. It is the fundamental law of financial physics. There is a profound difference between how an individual views debt and how an institution views debt. For a person, debt is often a burden. It is a mortgage, a credit card bill, or a student loan. It is something to be paid down. For a corporation, a private equity firm, or a wealthy family office, debt is a tool. It is a source of leverage. They use debt not because they have to, but because it is cheap capital that can be deployed to generate a return higher than the cost of the loan. This is the essence of financial engineering. If a corporation can borrow money at 5% and invest it in a project or an acquisition that yields 10%, they have created a 5% return for their shareholders. The debt amplifies the profit. This is known as leverage. It is the invisible force that multiplies wealth on a scale that wage earners can barely fathom. A middle-class family might have a mortgage that feels oppressive. A real estate tycoon has a portfolio of mortgages that makes them a billionaire. The difference is not the debt itself. It is the understanding of what the debt buys. The tycoon uses debt to acquire cash-flowing assets. The assets pay the interest, and the appreciation builds equity. The family, by contrast, uses debt to consume a home. The debt is a liability on a personal balance sheet, not an instrument of production. The corporate bond market is the lifeblood of global business. When a company like Apple or Microsoft has generated billions in cash, they often choose not to bring that cash back to the United States due to tax consequences. Instead, they borrow money in the corporate bond market, effectively issuing debt to pay for share buybacks and dividends. They are borrowing money, even though they have cash, because the tax code and the cost of borrowing make it cheaper than repatriating their foreign earnings. This is a classic example of institutional thinking. A regular person might find this absurd, borrowing money when you have cash. A financial professional sees it as an obvious arbitrage. The interest on the debt is tax-deductible, reducing the corporation's tax liability. The cash overseas can continue to grow. The bondholders, the pension funds, and the insurance companies buying that debt are content because they are earning a steady yield. This creates a symbiotic system where the issuer gets cheap capital and the holder gets a predictable return. This is how the financial system is wired. Every major corporation is a borrower, and every major pension fund or asset manager is a lender. The trading floor of the bond market is where these titans meet to decide the price of capital. The relationship between bond yields and stock prices is one of the most critical dynamics in finance. When bond yields are low, stocks look more attractive. Investors are forced to take more risk to get any return, driving up equity valuations. When inflation rises, bond yields rise to compensate for the eroding purchasing power of the fixed interest payments. Rising yields make existing bonds less valuable and make stocks less attractive relative to the new, higher-yielding bonds. This can trigger a systemic sell-off in risk assets. The market for bonds is vast. It is larger than the stock market by orders of magnitude, with trillions of dollars in debt outstanding globally. Within this market, there are forces that most people never consider, such as the yield curve. The yield curve is a graph that plots the yields of bonds with different maturities, from 1 month to 30 years. Under normal conditions, the curve slopes upward, meaning long-term bonds pay more than short-term bonds to compensate for the increased risk of inflation over time. Occasionally, the yield curve inverts. This happens when yields on short-term bonds are higher than those on long-term bonds. This is a financial anomaly that signals a lack of confidence in the future. It implies that investors believe the central bank will have to lower interest rates in the future to combat an economic slowdown. An inverted yield curve is the single most reliable predictor of a recession the financial markets have. It has preceded every major recession in the past 50 years. It is not a hunch or a guess. It is the collective wisdom of the bond market speaking with capital, not words. To truly understand the power of bonds, you must look at the concept of duration. Duration is a measure of a bond's price sensitivity to changes in interest rates. The longer the duration, the more volatile the price. This is a risk that institutional investors manage with great precision. A pension fund that owes payments to retirees 30 years from now needs to hold bonds that match that timeline. They are not concerned about short-term price movements. They are concerned about matching their assets to their liabilities. This is the world of asset liability management. It is the core competency of insurance companies, pension funds, and sovereign wealth funds. They buy long-term bonds to lock in a stream of cash flows that will meet their future obligations. For the wealthy individual, bonds serve a similar purpose. They are the ballast in the portfolio. The wealthy do not need to take extraordinary risks to achieve their lifestyle. They have already won the game. They are primarily concerned with capital preservation and inflation protection. They use bonds and other fixed-income instruments to create a secure floor of income that ensures their wealth will outlast them. This is the quiet conservatism of the ultra-rich. While the media focuses on the dramatic swings of the stock market, the elite are resting comfortably on a foundation of government and corporate debt. The bond market also serves as a mechanism of discipline. A government that spends beyond its means will see its bond yields rise as investors demand higher interest to compensate for the risk of default. This is the market's way of imposing consequences on fiscal policy. A central bank like the Federal Reserve uses open market operations, which is the buying and selling of government bonds, to influence the money supply and interest rates. When the Fed buys bonds, it injects liquidity into the financial system. When it sells them, it drains liquidity. This is how monetary policy is conducted. It is not done through direct manipulation of the stock market. It is done through the bond market. The interest rates you pay on your credit cards, the rates your savings account earns, and the cost of financing a business are all governed by the actions in this colossal market. It is the world's largest marketplace for debt, and it operates with a sophistication that dwarfs the more public exchanges. It is largely over-the-counter, meaning trades happen directly between institutions. The prices are determined by negotiations and algorithms, but the underlying reality is the same. It is about the present value of future cash flows. Consider the year 2008. The financial crisis was triggered by a collapse in the subprime mortgage bond market. These were debt instruments secured by mortgages. When housing prices fell, borrowers defaulted, and the bonds that represented those mortgages lost their value. The shadow banking system, which was heavily invested in these bonds, became insolvent. The crisis did not begin with a stock market crash. It began with a loss of faith in the promise of a bond. It began with the realization that the collateral backing a bond was worth less than the debt itself. The bailouts that followed were essentially the government stepping in to backstop the debt system. The United States government guaranteed the debt of Fannie Mae and Freddie Mac, the mortgage giants, to prevent a complete collapse of the housing finance system. The banks that were bailout out were propped up on the belief that the government's own debt was the ultimate safe harbor. It was a profound lesson. When the bond market seizes, the entire financial system seizes with it because everything else is priced relative to it. Money is debt. Central bank money is a liability on the central bank's balance sheet. Commercial bank money is a liability on the commercial bank's balance sheet. Every dollar in your pocket is a claim against an institution. Bonds are simply the most direct, most formal, and most transparent expression of that debt-based architecture. To understand this is to understand that wealth is not a stack of cash. It is a hierarchy of claims, and bonds occupy the top tier. The final layer of understanding is the tax advantage. In many jurisdictions, including the United States, interest on municipal bonds, issued by state and local governments, is exempt from federal income tax. This is a powerful incentive for wealthy individuals in high tax brackets. They prefer to buy a tax-free municipal bond with a lower yield than a taxable corporate bond with a higher yield, because the after-tax return is often superior. This is a perfect example of how the system is designed. It is not a conspiracy. It is a legal structure that rewards the wealthy for investing in public infrastructure. It shifts their behavior not through force, but through the quiet logic of the tax code. They will take a slightly lower return to avoid sharing the gains with the government. This is the kind of calculation that is second nature to the financial elite. They are constantly optimizing for after-tax returns, cash flow, and preservation. They are always comparing the risk-free rate to the risk of an alternative. They are always measuring duration and yield. They are always aware that the market for bonds is the market for the world's most valuable resource, certainty. To them, a stock is a chance. A bond is a promise. And while fortunes can be made on chances, they are truly secured on promises. The bond market is the bedrock of that security, and understanding it is the difference between looking at money from the outside and moving it from the inside.